Hello, everybody. Today I'm going to be talking about Project One, which is making a short term decision in venture capital. Um, Today, I carefully created a portfolio that adheres to the given criteria of investing in three companies with varying levels of risk while ensuring a maximum initial investment of $3 million and a 4-year payback period. To achieve this, I've analyzed the provided data in the table that was provided on potential investments, taking into account the risk of bankruptcy and the initial rate of return, otherwise known as IRR. After careful consideration and research, I have identified the following companies as the best performers in their respective risk categories based on their IRR. The first company that we are going to be looking at is TELUS Tech Inc. They have a very high risk of bankruptcy as they invested the most in their initial investment of $720,577. Calculating this all up, you find that their internal rate of return is at 17.2%. The next company is 4.com. They are a medium risk with their initial investment of $316,754 with a calculated IRR of 18.5%. Lastly, we have Gray Investment Co. Their risk of bankruptcy is low, and they also had a low initial investment of $289,618. And you can see that their IRR is 11.7%. Just to give you a view of what this looks like, going back to the high risk company, you have TELUS Tech Inc. Shows their initial investment on the right of $720,577. And then you can go through the years all the way from 0 to 7 and see each number for each year. And their IRR is the highest among high risk companies at 17.2%. The next one we have is 4.com. They are a medium risk company. Their initial investment, you can see in red again, is $316,754. And then going through years 1 all the way up to 7, you can see that their IRR is the highest among medium risk companies at 18.5%. And lastly, we have Gray Investments Co. This is a low-risk company. Their initial investment, again, all the way to the right, you'll see it's $289,618, all the way up to year 7 at $78,454. Their IRR is the highest among low-risk companies at 11.7%. Now let's examine how these companies fit with the overall portfolio. If we go back a couple of slides, you'll see that the total investment for the three companies that were chosen amounts to a total of $1,326,949, which is well within the allocated budget of $3 million. This leaves us with sufficient capital to further diversify our investments or allocate funds for potential future opportunities. With this table, it's crucial to consider the risk diversification within the portfolio. By including one low risk, one medium risk, and one high risk company, we can ensure a balanced exposure to different levels of risk. This strategy minimizes the impact of potential losses from any single company and increases the overall stability of our portfolio. I've ensured that the net cash flows from the chosen companies enable a repayment of the initial investment within 4 years. The net cash flows for all three companies meet this requirement, allowing us to recoup our investments in a timely manner. My portfolio comprises Gray Investments Co. as a low risk component, Four.com as the medium risk component, and Telestech Inc. as the high risk component. These companies have been selected based on their high IRR within their respective risk categories, while adhering to criteria of diversification, maximum initial investment, and a 4-year payback period. By investing in this well-balanced portfolio, we aim to capitalize the potential growth opportunities while mitigating risks associated with each category. By assessing all three of these, I'm confident that this portfolio will deliver strong returns for us and provide a foundation for long-term success.